What is up, everybody? Before you guys go ahead and watch this next module, if you want to watch me and the team trade live for absolutely free for 7 days, as well as get access to everything that we have within the Learn the Markets Discord community, go ahead and check out the 7 day free trial. If you're not already in the Discord, I will attach a link at the description of this video so you can go ahead and check that out.
What is good, everybody? Welcome back to another LTM crash course video. Today we have module 4, and we're going to be diving into market structure as well as breaks of structure. Now, these concepts are going to be absolutely pivotal because they allow us to do two critical things. They allow us to gauge direction via market structure, and they allow us to gauge when direction is actually shifting via breaks of structure. Okay, so with that being said, let's actually dive into these concepts. Starting off with market structure. Market structure is what's going to allow us first and foremost to take note of the overall trend direction that we're seeing in price. Okay, so that this is what's going to allow us to actually be able to label an uptrend, and a downtrend. Okay, but what actually makes up an uptrend, for example? Let's actually dive into that. Now, an uptrend is going to be composed of higher highs and higher lows. So if we see right here, we have a push to the upside, we retrace, and then we have another move to the upside that creates a subsequent higher high than the first initial high. And when we retrace, we put in a higher low, hence why we call it a retracement, right? Because we did not take out the first initial low, and we from there, after putting in this higher low, what did we do? We got a continuation to the upside, put in another higher high, retraced higher low, respecting the previous higher low, and then continued higher. This is how we're actually going to be able to recognize an uptrend. Now, a downtrend is going to be the complete opposite. Okay, so if we look at this example right here, essentially we have a move to the downside, we put in a low, we retrace, put in a high, and from there we put in a subsequent lower low, then retrace lower high, subsequent lower low, lower high, and so on and so forth. And these are retracements because we don't take out the previous lower high. Hence, we're continuing to that downside with that bearish momentum, developing a downtrend. Now, there's a huge misconception that price action is just going to move in a straight shot up or in a straight shot down. And that is not going to be the case. Very rarely are you going to just see these explosive fucking moves that are just going to continue. No, right? Price is just not going to continue in an uptrend forever or in a downtrend forever. As a matter of fact, price doesn't actually have to trend in some cases. So what are we actually going to label that? How are we going to call that? That is going to be called consolidation, my friends. And all consolidation is when price action is not actually trending in a specific direction and is trading in between a respective high and a respective low, ultimately respecting this range and trading within that range of that high and that low. This is what we would label not a trending market, hence consolidation. Now, the reason why market structure is absolutely critical to us as traders is because once we're actually able to take note of the overall trend and direction that the market is developing in, it then becomes our job as traders to align ourselves with that trend. There is a reason why the saying, trend is your friend, exists. Okay, guys? More importantly, once you're able to take note of these trends, there's no reason for you to go against it unless there's an actual shift in that trend, which we're going to cover with breaks of structure. But the whole reason here is that we're not trying to actually time the market. There's no reason for us to try to time a reversal. If price is developing in an uptrend, there's no reason for you to be trying to time every top as a reversal, or the same thing vice versa for a downtrend. Okay, so once you guys are able to take note of these trends in the larger time frames, because the larger time frames are going to hold much more power, because you're essentially getting like a bird's eye view of overall price action. Okay, once you're able to do that, it is then your job, once you go into the lower time frames, to align yourselves with that trend and that narrative that you see on the higher time frames. All right. Now, you may be thinking to yourself, okay, this is all fine and dandy, but you were literally drawing lines. How are we going to relate this back to actual candlesticks? I'm glad you asked. So let's actually go over some examples marking out market structure, and then we can pinpoint some of these key principles that you guys have to take into account when actually doing this yourselves. All right, so we're here on the daily time frame on ES, and all we're really going to be doing is picking a random spot on the chart and going through it, marking out structure and covering some key points that you guys need to take into account. Now, I highly encourage all of you, if you guys are not familiar and are not fluent ultimately with this concept, if you're not comfortable with it, this is one of the biggest things that you should be doing. Do exactly this. Go through the different time frames and just mark out market structure and understand where your actual higher highs and higher lows are, okay? So I'm going to start, let me just draw. I'm going to start essentially from this point, and I'm going to work my way up from point A to point B, and then I'm going to work my way from point B to point C, because here, just to the naked eye, it's going to be very easy that from point A to point B, this is an uptrend, but from B to C, it's a downtrend, so let's actually cover and draw it out for you guys. All right, now that I got the path tool, let's just draw out price action and trace it essentially. So we have a move up, then we have 2 subsequent candles down, 3 up, down, up, then we have this like slight consolidation right here before we push up, down, up, okay? Drag that out to the right. This is essentially A to B. What do we see? Okay, initial high, initial low. Let me do that better. Initial high, initial low. We have a higher high, higher low, higher high, higher low. We do make a lower high here, but we also have to understand the context under which it's developing in. It's developing during a consolidation. But during this consolidation, do we ever actually break the previous higher low? No. So there's no break of structure. That's a little bit of foreshadowing of what we're about to get into. But we never break structure to the downside. We still respect the previous higher low. And then from there, we have another leg to the upside, higher high, higher low. Okay? And as you guys can see, one price action is not always just going to develop super cleanly and beautifully with a straight shot up or a straight shot down, like I had said, which drives even more emphasis why it's so incredibly important for you guys to actually understand market structure and do this exercise, okay? Go through the chart and draw it out. Now, you guys may be asking yourselves, each candle has a high or low, so how are we actually going to know what's a high or low in terms of structure? This is exactly how you're supposed to do it. A low of structure is essentially going to be composed of 2 candles. A down closed candle followed by an up closed candle making that low. All right. And a high of structure is going to be the complete opposite. A high of structure is going to get made with an up closed candle followed by a down closed candle, leaving that high right there. Okay. So now that you guys can understand that, it should even make more sense when you're going through it, what your actual higher highs and higher lows are. Okay, so now let's actually cover B through C. Okay, now let's cover B through C. We have the initial high here, and then we have a push down, lower high, push down, push up, push down, push up, and push down. Okay, so if we jog that out right here, okay, actually, no. I don't like that. Let's do it right here. Okay, so what do we have? We have the initial high. Okay, then we have the initial high here, but we have the leg down. So we have the low, the high. Then we have a lower low, lower high. We respect the low essentially here, the low here. And then what do we see? We actually see this lower high get broken right here. And a lot of you guys would be thinking, oh, this is a break of structure. Once again, foreshadowing, even though we haven't covered it yet. Now, what is going to help you guys here to actually be able to identify the key points of structure are essentially going to be the swing points, the key external swing points of these moves without getting too caught up on what's happening with the internal points of structure. That is something that is going to be absolutely critical. And once again, the only way that you're going to get better at this is by actually drawing it out. So once we draw it out, what we see is, yeah, we take out this lower high, but the external key lower high is still untapped, unmitigated. Nothing has happened to it. Hence why we're then able to get a continuation to the downside and ultimately put in a lower low right there, okay? So that way you guys are able to see the distinction between a key external point and then internal structure, okay? Now that we've covered this, let's actually cover breaks of structure because we've essentially covered 2 examples that have had it, okay? So what is an actual break of structure? Okay, so breaks of structure are essentially going to allow us to take note when price action is giving us signatures of when we could be seeing a potential reversal or a switch in overall trend and direction. If we were developing to the downside, which is clearly what we see here, right? We see consistent lower lows and lower highs. A break of structure to the upside is going to come when price action is able to close above. Keyword, close above. It is not going to be a candle wick, okay? And I'm going to show you examples of that, but it is not a candle wick. It has to close above the previous lower high, and that is what we're going to consider a break of structure. Why? Because we have now taken out a lower high. Price action has made a higher high, and what we could be potentially seeing after that is a development of bullish structure after that break of structure to the upside. Now, for a break of structure to the downside, okay, what we see here is an uptrend, right? We're developing with subsequent higher highs and higher lows, and then price action is able to take out and close below the previous higher low. Once again, guys, I know I sound like a broken fucking record box, but you have to understand it. Price action has to close below that high or that low that you are taking a look at for it to actually be considered a break of structure. Now, when we're back on the charts, we actually went over an example that clearly showed a beautiful and clean break of structure. So let's actually go through it. What we were seeing here, right, previously was price action was developing with overall bullish momentum, right? And the previous higher low that we made was this one right here, right? Here. This was the previous higher low, right? Because if we draw it out once again, we have a push up, down close candle, up close candle, and then 3 down close candles after that. So what we see if we actually draw out price action is this right here. This is what we see. And we close below, as we can see, this candle closed below that previous subsequent higher low, just like we did right here. And that signals our break of structure to the downside. Following that break of structure, what can we see price action do? We could see price action print a lower high right here, and then continue to print a lower low. And then we briefly covered this, but let's go ahead and cover it in greater detail now and actually reinforce the principle. A lot of you guys here would be like, oh, this is a break of structure to the upside. And you're not wrong. But what matters here, once again, is going to be context. And the context is that if we draw price action out, what we see is that the previous external point of structure, which is this one right here, this previous lower high, it never gets broken past above. So what we see is an internal point that does get closed above. And what you'll normally see is you'll see that actually happen a lot. A lot of these internal highs and lows will actually get broken or manipulated before an actual continuation. And that's exactly what we see here. We see essentially a fake break of structure. Not a fake, but yeah, because we actually break above the lower high. But what ends up actually happening is that because we don't take out the actual external lower high from the continuation to the downside and that leg that gave us the break of structure to the downside, we are still overall looking bearish. And what we end up doing is, in comparison to this previous lower high, we actually print another lower high as well. Hence, we then have a continuation to the downside. Okay. So here you're able to see not only break of structure, but more importantly, which points of structure to actually be placing more importance on, in this case, the external ones. Okay. Now, because price action is fractal, and we briefly talked about this in the previous module, you guys are going to be able to see these concepts displayed essentially across all of the time frames. Now, with that in mind, you guys have to understand that the higher time frames are obviously going to hold more importance, because higher time frame narrative essentially gives you a macro view without subjecting yourself to all the noise that you would be seeing, for example, on a 1 minute chart. On a 1 minute chart, it's going to be so hard to gauge the actual higher time frame direction, because every single candle that you're looking at is going to be 1 minute, and you're not actually essentially able to zoom out. With that in mind, just because you're able to see these concepts just like a break of structure on every time frame, keep that in mind, that just because there's a break of structure on the 5 minute doesn't mean that the overall larger time frames are shifting direction. So that's going to be absolutely critical for you guys to understand. And I actually want to show you an example right here. On the 4 hour, we close above this previous lower high, external lower high, because we had also closed above this one right here. If I drag this, so we already had our actual break of structure right here, and we also closed above this one right here. And we then started developing with some bullish momentum, right? Because we put in a higher low, we respect this higher low, higher high, we then continue higher high, higher low. But what we actually see is then this previous higher low right here ends up getting taken out. So we break structure to the downside, and you'd be like, wait, but we had already broken structure to the upside. And in points like these, I really, really, really want to emphasize, just zoom out, because what we end up seeing is that the daily had also broken structure to the downside once we were able to close below this previous higher low right here, which is this one right here. And the daily was just retracing, putting in a lower high. So what was a break of structure to the upside on the 4 hour just ended up being a retracement on the daily to then continue lower. So keep that in mind, especially when it comes down to these smaller time frames. All right. With that being said, that essentially wraps up module 4. Market structure and break of structure is finito. I will catch you guys in the next module. As always, stay safe and stay blessed.